Hey folks, welcome to yet another episode of Business Redefined, your weekly, most comprehensive look at the world of business, finance, and economics. Asset management has been vibrant over the last 2 years. In this market, Kenyans have been characterized by what has been now been termed as the MMF rush. That's money market funds. All of us want a piece of the pie and the action that is happening there. We are privileged to have Mr. Einstein Kihanda, CEO, ICEA Lion Asset Management. That's ILAM. Karibu sana, Einstein.
Thank you very much, Julian. I'm glad
Good to see you after a long time, man.
Yes, it's been a while, but here we are.
ILAM at 40. How do you feel about it? How is the market landscape? It's increasingly competitive. How are you keeping up?
No, it feels great. It means that our clients have entrusted us with their funds for the last 40 years. We've been growing consistently over that period of time. Of course, the landscape, as you see, has been very competitive. And we've also done our best to stay on top of our game and ensuring that we're delivering competitive returns to our clients, and looking forward to making a difference, an impact in the investment landscape as an asset manager in this market.
Einstein, ever since the yield curve corrected and yields began tumbling down, Kenyans began asking me, is the MMF party over? Is it over, Einstein?
I think, of course, over a period of probably a 2-year period between 2022 and 2024, we saw that significant surge in interest rates. But of course, in terms of the correction, it wasn't from a cost perspective with higher levels of interest rates. Of course, for the government, that's a significant cost, and therefore, at some point, that had to correct. And it looks, going forward, that this decline or stabilization will continue to happen. So I would say yes, and I think that also presents us with challenges in terms of being more innovative, in terms of ensuring that we're delivering products that meet the expectations of our clients.
Yes. How is the spectrum of your offering looking like? Increasingly, we see fixed income funds, we see bond funds, we see many variations out here. What does ILAM put out as a market proposition in terms of, if you come to us, you have this wide array?
Yes, so we've got retail funds, and I think I'll talk about that. Starting off, of course, with the money market fund. We have got a money market fund. We have fixed income funds, both in terms of Kenya shillings and US dollars. We've got an equity fund. We have a balance fund. We recently launched a multi-strategy bond fund that is also doing very well for high net worth clients.
I can imagine the entry point there is quite elevated.
The entry point is 5 million shillings and above.
Yes, Yangu.
Yes. And we also have private wealth management portfolios, which are really bespoke portfolios that we offer to our clients who want a dedicated, relationship manager, and we're able to tailor the investment portfolio to suit their investment objectives. So, and we continue to be innovative in terms of ensuring that we're able to bring products to the market. And so you'll be hearing a lot more beyond this current suite that we have. We look forward to launching even more products. We pride ourselves in having a fairly significant experience and capacity in terms of fixed income. And I believe our fixed income funds, both Kenya shillings and dollar, are delivering very good competitive returns in the market. And we also very big on terms of retirement schemes. We manage segregated funds. We have more than 60 retirement benefit schemes that we manage. In addition to managing portfolios for insurance companies, including the group, as well as trusts. So we have a comprehensive range of products that suit a wide cross-section of clients in the market.
Given your wide stable, Einstein, maybe you're the person who is best positioned to answer this question. The concentration that we see in government paper has been a long-running discussion in this country. 2.2 trillion worth of assets, 54 thereabout% in government paper. Is it that you are not seeing bankable asset classes on the other front, or what is exactly at play here?
I would say that actually there's been a lot more progress in terms of diversification. And I think that is also why you're seeing a lot more products coming into the market that are off the government securities. And then it's clearly because, and I can take you back a bit to, from a bit in recent history. I think with the corrections that we've seen in the markets probably 2-3 years ago, I think the importance of diversification was made very clear. It's always been important to be able to ensure that there's portfolio diversification from an investment management perspective. But I think because of possibly the high levels of interest rates that have been offered by these government securities, from a comparative perspective, it's not been as easy to present an alternative suite of investments for to the market, especially for institutional clients like retirement benefit schemes, which have been very risk averse. Because the other perspective I can also give you is, we've also have challenges in the market where we've had corporate issuers and other players in the market, collapsing, especially probably about 10 years ago.
Yeah.
And I think that has also created an environment where investors are risk averse and probably looking to ensure that they protect their portfolios. Capital preservation. That has been a significant reason why we've seen that prevalence. But I think as the market becomes more sophisticated, and even with the yield correction, I think it's important. We are seeing a lot more in terms of engaging our clients in terms of alternative investments, and that I think the conversation is gradually shifting. Probably not as fast as we would want it to happen, but I think it's clear that we are getting there. And I think if you look at recent publications, I think even the Business Daily this week, it was talking about the kind of investment that have been made in alternative assets by pension funds. So it's gradually shifting the conversations. And I think as fund managers, what we are therefore doing a lot is also engaging in investor education, talking to our clients about these opportunities, and also enhancing our capacity as fund managers in ensuring that we are able to present these opportunities, do the necessary analysis and research, and present these opportunities to our clients to invest in. So the landscape is changing.
Einstein, one of the arguments that I've leveled is that if 2023-24 could be characterized as the MMF rush, then 2025 is certainly what we call the special funds rush. And I'm very curious, given your legacy, the heritage, the kind of assets you have, the offering you put out in the market, is this something which is on the table for you as a consideration?
Oh yeah, sure. We've also been very careful. What we also don't want to do is also being more or less what you'd call like a bandwagon. We have to look at what it is that we are offering and presenting to our clients, so that it's not just one other, special fund. We are also have plans, in the pipeline to ensure that we'll also be able to present these opportunities to our clients, having understood especially the underlying securities that you'll be able to present, in the investment portfolio. So yeah, and you'll be hearing a lot more, not in the not too distant future, about the products that we'll be bringing to the market. So certainly that is something that we are very keen on, to ensure that we continue to remain relevant and present opportunities to our clients.
So are you looking Q1 26, Q2, or what timeline do you have?
At least I would say within the first half of 2026, we should see a lot more in terms of what we'll be bringing to the market.
Help us understand a little more your multi-strategy bond fund, you call it. Yeah, tell us about it.
I think for the multi-strategy bond fund, what we basically do is be able to invest in a portfolio of fixed income securities. And what we therefore are able to do is, first of all, in terms of the investment limit, it's 5 million shillings and above. And then what we've been able to structure is an offering that has liquidity provision, and we are able to offer, based on the current rates of interest in the market, rates on three-month basis, 1 year and 3 years. So that those are the three categories. And what we want to be able to do is to present liquidity propositions to our clients with competitive rates of interest. And the rates change on a depending on when you're making the investment. We are able to present you with the market rates prevailing at that particular time when you're making the investment. So that ensures that we are presenting competitive investment opportunities to our clients. And that is really the underlying portfolio, our fixed income securities, which we then structure
local and external, or just local?
Currently it's local, but of course we'll be looking to looking at the externally as well. But the current portfolio is primarily local.
Wonderful. I'm curious about the liquidity sweetener bit of the multi-strategy bond fund. And I'm asking that because if you look at our secondary markets, they tend to be fairly illiquid. And that's part of the challenge we have with the fixed income assets. Then how do you bake in the liquidity aspect in that bond fund?
I think because of, again, as I talked about the capacity that we've been able to, there's also, from a liquidity perspective, I think there's still significant activity in the secondary market. And that I think presents us with opportunities. As I said earlier on, over the time, we've been able to build a significant fixed income book in the market, and using and delivering very competitive returns to our clients. And so we are leveraging on that capacity and expertise to now bring this offering to the retail space, albeit at a higher threshold. And so that secondary market activity is what we've also been able to utilize to ensure that we present the liquidity portion of the offering to our clients.
Einstein, for a long time, because of the sort of bear run, if I could call it, you had in the equities, I kept on asking, are balanced funds dead, essentially? And there was really little appetite for them. Given what we have seen, especially in 2025, are balanced funds coming back?
I think gradually. Again, there certainly is room for that in the market, but I think we have seen, of course, the wave in terms of money market funds and the correction in terms of the equity market. So there's still some level of, I would say, recovery. But I would say that it is something that requires a lot more engagement and product knowledge and product information to the market. I say that because on two factors. One, from a money market fund perspective, looking at what the alternative is. So money market funds are very easy to understand in terms of investment return and also in terms of liquidity and risk. There's also been some element of trauma. I know that you've talked about the recovery we've seen in 2025, but you also know that prior to that, there's been a lot of challenges in terms of the bear market that prevailed previously.
It was too long.
It was too long. And so there are still a lot of investors who are very risk averse and recall that historical trauma. So it may take time. If you look at the kind of cycles we have in our market, I think it will take time to recover. But certainly there is some room for that space for investors who have a more balanced risk appetite for their portfolios.
Oh, interesting perspective. On the policy environment, Einstein, how do you see the landscape and how is it facilitative of the sort of instruments you're putting out?
One, let me start from a regulatory perspective. I think from a regulatory perspective, the Capital Markets Authority has been very innovative in terms of engaging with players in the market and ensuring that there is an understanding or there is an appreciation of what what fund managers have to offer in the market. And I think that has contributed significantly to the growth that we've seen in the market. So I would say from a policy perspective, from a product and regulatory perspective, the environment has been quite enabling for that to happen. I think you just need to look at the kind of communication and the products and that are coming to the market.
Yeah.
And even personally, even as an institution, we've seen a lot of engagement, with our regulators. So that has, I think, presented an opportunity for innovation. You've seen a lot of, especially in the CIS space, with the regulations, the 2023 regulations that now more or less streamlined the unit trust space in as far as naming of special funds, the kind of underlying portfolio that all these unit trusts should have, which was fairly comprehensive, and that actually involved the market players in terms of contributing to the inputs into the regulations. That I think has triggered a lot of innovation in the market, and we've seen the proliferation of a lot of the new funds in the market. So I would say that has created an environment for innovation and new products coming to the market. And I also think from a fixed income perspective in terms of government borrowing, I think that has also been, I would say to some extent also been facilitative because of, the wave, if you look at the last 2 years, 2023, 2024, with higher levels of interest rate, I think that also triggered a lot of interest by investors who are seeking to earn, competitive returns for their investment portfolios.
Yeah.
So that has also contributed to that growth that we've seen in the market. And also a lot of education. I think I should also mention part of what was also seen a lot of activity on the retail space is a lot of investor education. And both from a regulator and even from a player's perspective, there's been a lot of effort to encourage and enhance investor education in the market. And I think that has helped, especially utilizing the channels that we have, social media and other channels for communication to the market. That has helped in terms of seeing a lot of growth in the retail space for investment.
Einstein, you do have some dollar funds in your portfolio. I'm curious, in 2022-23, when we saw the shilling being roiled significantly, there was a lot of appetite for dollar exposure in this market. Has that changed? And also from a return perspective, because of the sort of posture we have seen with the US Federal Reserve in terms of cutting rates, are you beginning to see a recalibration, if I could call it, where Kenyans are saying, okay, finally, let's hold the case and not the USD?
Yeah, I think again, certainly, as I say, 2023 was a lot of activity on the dollar market with the launch of new products. And I think with the stabilization of the shilling, probably now for almost 2 years now, at a fairly stable level, that I think has shifted. There's a lot more focus in terms of long term, as opposed to being very speculative. Because you recall at that period of time, there's a lot of speculation. It was very speculative. And if you remember, the underlying reasons were about the maturities in terms of the Eurobond that was coming up in June. That was sorted out. We've seen even a further refinancing subsequent to that. So I think that has been
very proactive, by the way.
Yeah, there's a lot of proactivity. And I think that has fairly more or less stabilized the level of interest in terms of dollars. But that also means that for an astute investor or somebody who has long-term plans, if you're an individual with a few dollars and you're looking to expect that you have certain obligations that you'll be meeting in the future, whether it is about educating your children abroad, etc. So I think it's more from a normal personal financial management perspective as opposed to being speculative. About
we're hedging ourselves.
Yeah, we're hedging ourselves. So I think that has created some level of stability, and that has also helped in terms of ensuring there's sobriety in terms of how you're engaging with investors and talking to them about the market. So now we are talking about dollar funds as part of your normal personal finance in terms of the investment portfolio, as opposed to, as part of what you would normally do as somebody who is very careful and prudent in managing your personal finances.
By the way, for the avoidance of doubt, and just for clarity here, if I wanted, for example, a dollar MMF, will ICEA, ILM ask me, show us proof that you have dollar proceeds, whether it is an income stream or something, or how does it work?
We'll just go through the normal KYC process in terms of, the normal process in terms of ensuring we have details about your bank account, your bank statements, your PIN, the normal process, and then we will then be able to ensure that we have onboarded you. So there's nothing unusual. It is just in terms of ensuring that you have the bank statements and the normal information that we require for setting up a unit trust. So it's more or less the same procedure that we follow in the other Kenya shilling denominated unit trust.
Okay.
Yeah.
I know we keep on celebrating what we have now called the MMF rush in this market. It's been extremely democratized, but there are those who are still asking, how do we push this further downstream? There are many Kenyans who still, their perception of investment is stable banking. So we aggregate our funds together. This month we're giving Einstein, next month we're giving Agatha, then it follows that way. How do players like yourselves reach that segment of the market?
I think it means that we have to invest in the distribution.
Yeah.
So there's the distribution and there's also the communication. What are the channels that you need to use to ensure that you reach out to as many people as possible? How do you make it easier in terms of denominations for people to invest? And I think to some extent we've done a lot. For instance,
so, yes.
for instance, in our money market, if you have 500 shillings
you can
and above, you can start. It's a bit higher for the dollar because you need $500 to be able to invest. But I think we've done a lot in terms of ensuring that you have the technology. Again, it's through the phone, ensuring that you have the channels that will ensure that that person who has that amount of money, small amount of money, can be able to invest. Fortunately, in Kenya, we know that the reach in terms of the digital space is significant because very many people now have, on average, people have 2 lines.
Yes.
And that means that if you're able to have the right digital platform, including, for instance, the mobile app, having a mobile app,
Or USSD as well.
or USSD,
Yeah.
or for instance, we also have in ICEA, we also have a WhatsApp chatbot. All those channels that will ensure that people are able to transact from end to end on the phone, that should be possible. I think the missing, the additional thing that needs to happen is really just regular engagement and communication and reaching out to these people as much as possible. So there's, of course, a lot more that needs to be done to ensure that you bring in as much of the population as possible. And I think we've made significant steps in that regard. But as I said, a lot more needs to be done in terms of ensuring that we are able to reach out to as many people as possible. But it all borders on technology and on distribution.
Okay.
Yeah.
Einstein, I have a bit of a live wire here. This market currently is hotly debating the pricing of corporate bonds. For one simple reason. We have 2 issuers who have gone to market, and the coupon issued is almost as good as the sovereign. What do you make of that as a fund manager?
So let me start. Of course, I know the issues that you're talking about.
Yes.
And I would start by looking at what is when you're making an investment and when you are looking at analyzing the issue of a bond, one of the things you ask yourself is, what is the capacity of this issuer to repay this bond through payment of interest when it is due and on the principal
Maturity.
on maturity. If you look at those 2 issuers, number one, those are dominant players in the market. They are both listed.
Strong balance.
Very strong balance sheet, yes. Very strong track record in terms of investment performance and in terms of financial performance. Yeah. So you can almost with certainty look at what the cash flows have been. And as a result of that, they have the confidence to be able to say that we can be able to come to the market and present an instrument, and you almost have certainty that this was going to, we would ensure that the repayments happen. Yeah, on schedule. And you've seen they've come to the market before, they've issued instruments, they've repaid them. So from a confidence perspective,
one even did an early redemption.
Yeah, one has done an early redemption, and so there's something you can back on and say that this is what has happened. Of course, I would not say that you'd compare that with the sovereign, but what they're also saying is that, you see, what does the sovereign require to be able to ensure also that you're able to make the repayments? Yes. You raise funds through tax revenues, and you come to the market. I mean, you have various mechanisms that you are able to utilize to ensure that you collect the revenue that you need. So, I know, as you said, it's a live wire. So the question is, when you compare those 2, so one on the other hand are saying, with us, you are. I mean, we already have shown you that, yes, we don't have an issue in terms of being able to meet our agreement. The sovereign hasn't also had issues
either. Yes.
Either. That is really the context in which the pricing is coming to. They're saying, you have no doubt about our ability to repay our obligations when they mature.
All right.
Yeah.
Einstein, my boss Agatha here is on my case about time, so let's wind up. The last time you and I sat here, Einstein, we had a very long conversation about the restructuring of the REIT.
Yes.
How is it ever since that time?
Yes, so we've done a lot. There's been, I think, when we were sitting here, we were talking about the redemption of issuance, and subsequent to that, of the units to non-professional investors, which subsequently happened. And we also undertook the delisting of the REIT from the Nairobi Security Exchange, the main investment market segment, which happened in February last year. After that, we admitted, the REIT was admitted to the unquoted securities platform, the UFP platform. That has happened. We also completed the restructuring of the property portfolio and exited two underperforming properties in the industrial area. And what we've now done is that we are now embarked on our next phase in terms of our strategy. And this is about repositioning the REIT to be able to now undertake and execute the strategy that will position it to ensure that we are able to come to that we're able to give the investors value for what they have invested in. So we'll also be coming now with a lot more information in terms of what are the plans that we have for the REIT, especially in terms of the investments that we'll be making, and ensuring that we are able to both optimize the existing portfolio and also invest now in additional investment properties that will ensure that the REIT grows in terms of its value and its offering to investors. So we are keen on ensuring that we are able to enhance our presence in the market as a real estate player in this particular segment. So again, you'll be hearing a lot more, and I look forward to another conversation soon once we concretize this and we're able to share with our investors.
Einstein, I know you've been a bit guarded there, but it looks like from a market positioning of the REIT, you are changing it, if I could say completely, in terms of the properties then you take on.
Yes, we are changing in a way, because what we then had to do was to deal with what was the existing portfolio. So what we are doing with the properties that are remaining is really enhance those, and also now, and of course what we want to do, ensure that we're able to do. You see, it's important that as you engage the market, you also need to demonstrate a good track record in terms of being able to give confidence to investors that you are able to deliver on the promises that you're making. And that is what we want to be able to do. We want to be able to say that with what we already have, you can now trust us to do a lot more and be able to trust us with the ability to grow the investment portfolio. So that is what I'm saying in terms of being able to ensure that the offering we now bring to the market is sustainable in terms of its growth and delivering value to the investors.
I won't push you any further on that, because that will be the subject of our next interview. Mr. Einstein Kihanda, CEO, ICEA Lion Asset Management, covering a raft of issues, including the various products we are seeing in the market. MMF's multi-strategy bond fund, a special fund is coming in the market by half year next year, that is 2026. So we shall be keeping tabs on that to bring you the latest as and when it happens.